Hello everyone. Today, we will learn on chapter Post-Balance Sheet Events and Reporting. Completing the audit processes and procedures. In order to complete this work, the auditor should apply analytical procedures at the end of the audit when making an overall conclusion. This is to know whether the financial statement as a whole are consistent with the auditor's knowledge of business. These analytical procedures are intended to reconfirm with the conclusion made during the audit of individual account balances. For example, during substantive test, auditor concluded that account receivable is fairly stated. When analytical procedure on account receivable is performed, and if the result conclude that the amount is fairly stated, it looks like the conclusion need to be reconfirmed. And it can be based on auditor's opinion. The auditor should investigate and obtain adequate explanations and appropriate evidence. When the analytical procedures found any significant fluctuations or relationship that are inconsistent with other relevant information that change from predicted amount. What is post-balance sheet events? The financial accounting term post-balance sheet events refers to the disclosure of transactions and events occurring after the date of the balance sheet, but before the financial statements of the company have been issued to the public.
Post-balance sheet events, also known as subsequent events, are one of several types of information that is supplementary to the items appearing on a company's balance sheet. It can often take weeks after the close of an accounting period until the data is gathered into a financial statement. If materially significant information is gained during that time, disclosure is required. Generally, there are two categories of events or transactions that occur after the balance sheet date that can have a material effect on financial statements and need to be disclosed. The first one is events requiring adjustment. It includes conditions that existed as the balance sheet date that affect the estimates used in the preparation of the company's financial reports. If material, these events require an adjustment to the company's financial statements. Examples of situations calling for the adjustment of financial statements are lawsuit. If events take place before the balance sheet date that trigger a lawsuit, and lawsuit settlement is a post-balance sheet event, consider adjusting the amount of any contingent loss already recognized to match the amount of the actual settlement. Bad debt. If a company issues invoices to a customer before the balance sheet date, and the customer goes bankrupt as a post-balance sheet event, consider adjusting the allowance for doubtful accounts to match the amount of receivables that will likely not be collected. The next types of post-balance sheet events is events requiring disclosure. It includes conditions that did not exist at the balance sheet date but have a material effect on the financial condition of the company. These events should be addressed either through notes, supplementary tables of data or even pro forma statements. Examples of post-balance sheet events that do not trigger an adjustment to the financial statement are a business combination, changes in the value of assets due to changes in exchange rates, destruction of company assets, entering into a significant guarantee or commitment. Disclosure. Non-adjusting events should be disclosed if they are of such importance that non-disclosure would affect the ability of users to make proper evaluations and decisions. The required disclosure is A. the nature of the event and B. an estimate of its financial effect or a statement that a reasonable estimate of the effect cannot be made. A company should update disclosures that relate to conditions that existed at the end of the reporting period to reflect any new information that it receives after the reporting period about those conditions. Companies must disclose the date when the financial statements were authorized for issue and who gave that authorization. If the enterprise's owners or others have the power to amend the financial statements after issuance, the enterprise must disclose that fact.
Additional evidence in relation with contingency and commitment. Contingent liabilities is a potential obligation to outside party for unknown amount arising from activities that have taken place. Possible liabilities that come from the past events and the existence will be confirmed by the occurrence or non of one or more uncertain future events. Risk might be not completely and properly disclosed. Other than that, material contingent liability should be disclosed in the financial statement. For example, the lenders will be given corporate guarantee for loans to another party. Provision will be recognized as liability in the balance sheet. Contingent liability will be recognized when its existence will only be confirmed when there is an occurrence or non-occurrence of future uncertain events. Audit procedures to identify contingent liability. Read the minutes of BOD and examine the management and lawyer. Reviews contracts, loan agreements, leases and correspondence. Reviews income tax liability and tax return. Inspect other documents to have possible guarantees. Next. Commitments. It is an agreement to commit the entity to a set of fixed conditions in the future. Long-term contractual commitments usually to purchase raw materials or to sell their products at fixed price. These are identified through inquiry of management during the audit of the revenue and purchasing processes. Therefore, both contingency and commitment knowledge are very important to the users of financial statements. This is because they present the conditions of potentially material amounts of the resources which may be used during the future periods, as this will affect the future cash flows available to the users. Next, we will learn on ISA 570 going concern. An auditor is responsible in auditing financial statements for the management's use of going concern assumptions in preparation of the financial statements. Financial statements are prepared using going concern basis unless management decided to liquidate the firm, cease the operation, or has no realistic alternative in doing the business. The objective of an auditor in ensuring the firm's ability as going concern are: to obtain sufficient appropriate audit evidence regarding the appropriateness of management's use of the going concern basis, to make an opinion based on the audit evidence whether there is any material uncertainty exists related to any events occurs that may cast a doubt, and to report in accordance with the standards, if there is any event occurs that may affect the ability of the firm continue as going concern. The audit procedures that need to do are: request the management make its assessment, if they has not yet performed the assessment. Evaluating management's plans for future actions in order to improve the situation and management plans as achievable in the circumstances. If the firm had prepared cash flow forecast, they need to evaluate the reliability of the data generated and determine whether there is sufficient support. Consider any additional information available since the management made their assessment, and request for written representatives from management regarding to their plans for future actions and feasibility of their plans. What is the implications of the auditor's report? If the going concern basis is inappropriate, the auditor need to do adverse opinion. There are two situations if the going concern basis is appropriate but material uncertainty exists. 1. Material uncertainty was made in financial statements where the auditor need to express unmodified opinion and include separate section under material uncertainty relate to going concern, and 2. Material uncertainty was not made in financial statements where the auditor need to express qualified or adverse opinion. ISA 540 Audit Accounting Estimates. First of all, let's learn some terms in ISA 540. Accounting estimate means that an approximation of monetary amount that measured at fair value where the estimate is uncertainty. Estimation uncertainty is the weaknesses of an accounting estimate that related to the disclosure of inherent lack of accuracy in financial statements. Next, auditor's point estimate, which means amount that derived from audit evidence for the use and evaluate the management's point estimate. What is management's point estimate? It is means that amount selected by management for disclosure in the financial statements as an accounting estimate. However, management's point estimate may contain management bias. Management bias means that the lack of neutrality by management in preparing the information. An auditor did not have any authority in ensuring that the financial statements is free from any misstatement. That is why the auditor need to predict the outcome of one or more transaction that would giving rise to the need of accounting estimation. Why we need to do accounting estimation? Accounting estimation arises when some items in financial statements cannot be calculated precisely. Thus, The auditors are required to identify and assess the risks of material misstatement, where auditor need to evaluate the degree of estimation uncertainty associated with an accounting estimate. The auditor need to obtain the audit evidence whether the disclosures in the financial statements in accordance with the standards. Besides, an auditor must review the judgment and decisions made by the management in order to ensure that there is no management bias arises. Next is related party transactions. What is related party transactions? It is a transaction made between the related parties which either with or without any payment made. The transactions made are regarding to the transfer of resources, services or obligations. Who are the related parties? The related party can be individual or an entity that has connections with the firm that is being audited. Disclosure of related parties and preparing the financial statement is necessary. Such disclosure may include information regarding the related parties, the nature of transactions, and influence of the related parties to the firm. It is important to disclose the related parties' transactions because it is part of risk assessment procedure for auditor to obtain relevant information. This is to identify the risk of material misstatement that is in connection with the related party relationship and transactions. Management and auditor's responsibility in post-balance sheet events and reporting. Management's responsibility to the post-balance sheet events and reporting. The management is responsible to consider the impact of events that occur after the year end on the financial statements. Events that might occur are the adjusting events and non-adjusting events. Adjusting events are events that exist at the year end of the financial report which appear to provide evidence. Therefore, the management need to consider such evidence for the disclosure in the financial statements. The non-adjusting events are events that appear after the year end which related to the next financial statement period. If the events appear might materially affect the business, it is the responsibility of the management to disclose them in the financial statement. Auditor's responsibility in post-balance sheet events and reporting. The responsibility of the auditor in post-balance sheet events can be identified in two periods, which are up to the date of the audit report, between the date of audit report and publishing the accounts. Up to the date of the audit report is where the auditor have the responsibilities to perform procedures to identify events that need to be adjusted or disclosed in the financial statements. While the period between the date of the audit report and publishing the accounts is where the auditor is responsible to identify any adjustments or disclosures that need to be made in the financial statements. After identifying such events, the auditor need to take appropriate action. Example of action that can be taken can be in the form of requesting the directors to amend the financial statements and then reissuing the audit report. Active events on audit report. So, there are two types of event. First, non-adjusting event. Second, adjusting event. Non-adjusting event did not exist at the date of the balance sheet, but exist at the subsequent date. It is a need to disclose in the notes to the accounts, if it is found material. For example, purchase or disposal of a major business or subsidiary by the entity, issue of shares or bonds by the entity, adjusting event. These events affect the financial statement on balance sheet date which need to be accounted for the events. For example, bankruptcy of a customer that occur after the balance sheet date confirm that there's a loss existed at the balance sheet date on a trade receivable and therefore, the entity that need to be adjusted.
What is key audit matters? Key audit matters are those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period. Key audit matters are selected from matters communicated with those charged with governance. Those charged with governance are the persons with responsibility for overseeing the strategic direction and the financial reporting process of the entity. May include executive members of a governance board and owner-manager. Determining key audit matters. The auditor shall determine, from the matters communicated with those charged with governance, those matters that required significant auditor attention in performing the audit. In making this determination, the auditor shall take into account the following. A. Areas of higher assessed risk of material misstatement, or significant risks. B. Significant auditor judgments relating to areas in the financial statements that involved significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty. C. The effect on the audit of significant events or transactions that occurred during the period. The auditor shall determine which of the matters were of most significance in the audit of the financial statements of the current period and therefore are the key audit matters, communicating key audit matters. The auditor shall describe each key audit matter, using an appropriate subheading, in a separate section of the auditor's report under the heading Key Audit Matters. The introductory language in this section of the auditor's report shall state that A. Key audit matters are those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period, and B. These matters were addressed in the context of the audit of the financial statements as a whole, and informing the auditor's opinion thereon, and the auditor does not provide a separate opinion on these matters. Communication with those charged with governance. The auditor shall communicate with those charged with governance. A. Those matters the auditor has determined to be the key audit matters, or B. If applicable, depending on the facts and circumstances of the entity and the audit, the auditor's determination that there are no key audit matters to communicate in the auditor's report. Documentation. The auditor shall include in the audit documentation A. The matters that required significant auditor attention, and the rationale for the auditor's determination as to whether or not each of these matters is a key audit matter. B. Where applicable, the rationale for the auditor's determination that there are no key audit matters to communicate in the auditor's report, and C. Where applicable, the rationale for the auditor's determination not to communicate in the auditor's report a matter determined to be a key audit matter.